So I think for the rest of the Obama administration, I think you can consider the idea of crude oil exports to be probably dead, not totally. My friend Kevin Book estimates the odds of it happening in 15%, and he knows the odds down in Washington as well as anybody. So probably not going to happen, but not impossible.
So let's talk about another factor that's out there. There are 3 pieces of legislation out there. I won't go into them in detail that could set off sale of oil from the SPR. Back to our net import figure, the SPR is now way overfunded relative to the 90-day rule, and so you've got essentially excess. And you've got some numbers there from Kevin Book, who is a very well-known and well-experienced Washington energy analyst, and he's looking at these numbers here. He's saying that between 21,000 and 96,000 barrels a day could be be sold by the SPR under this legislation that's under consideration. To me, the really big question is, how do you sell it? That doesn't necessarily mean you're going to take your total authorization to sell, divide it up over the number of days over the authorizing period, and sell that much every day. You could go on all sorts of different auction possibilities. You could offer up an enormous amount every day, and then if you sell an enormous amount, maybe you don't go back to market for a week. How this would get done, if in fact the authorization goes through as part of the budget battle, is going to be a really significant question for this market going forward.
The important thing to point out is how efficient producers have become, even in this downturn kind of economy with lower prices. They're very resilient. They're figuring out ways of drilling oil faster and better, which has really kept them in the market and kept them competitive.
But now if we look at 2015, this is where we see a significant amount of improvements. So the most notable improvement was in the Permian. If you look at the Permian, it used to take 37 days to drill one well, and now it takes 23 days. The Bakken continues to improve, dropping from 20 to 13 days. Overall, the average days to drill one well in 2015 is 16 days. So that represents a 27% improvement from 2013.
If these kinds of prices persist, it's the integrated oil and gas companies that are still generating that positive free cash flow that I think gives them a lot of latitude to do a lot of different things that the independent E&P companies will not.
The exploration and production companies have fared the worst by far. Their earnings estimate for 2016 on the median one has actually gone down by more than 100%, which is at first glance it's a little bit hard to understand how the number could go down by more than 100%. But what it really means is that instead of operating EPS in 2016, now the median company is looking to post an operating loss.
Today on the webinar, I spoke about the Saudis in particular and what the market share war means for the upcoming OPEC meeting. OPEC can see the light at the end of the tunnel with its latest monthly report showing low prices cutting deeply into non-OPEC supply, which means growing demand for its crude and what OPEC itself considers a more balanced oil market next year.
Today in this webinar, I talked about the oil market and specifically the oil supply glut that happens at the moment and dominates the market.
It seems that global oil production is increasing as refineries continue to produce record high levels despite the recent investment cutbacks. Russian oil production climbed 0.4% to reach 10.78 million barrels per day in October, and following the recent strong increase, Russia became the world's largest producer of crude oil. Keep in mind that in September, OPEC's members produced 31.6 million barrels per day.
Today at the webinar I was discussing the parlous state of the European refining industry, where there's been a lot of consolidation over the last few years, and indeed there might well be more to come.
The challenges faced by European refiners, because the crude oil price in the last few months, particularly since November last year when OPEC decided not to cut production, of course it's had a huge impact on European refiners. And these companies haven't had it easy in the last few years, let's not forget. The high crude and maintenance costs and waning local demand has, of course, been met with increased competition from India and the Middle East, and that's all weighed very heavily on European refining profits. But since the shale boom in the US kind of turned the market upside down, that's when we've seen the real change, and the impact on suppliers of both crude oil and refined products has been huge.
Today in the webinar, I spoke about the credit implications in the EMEA energy sector given the current low-price oil environment. In this case, the pink line, which is generally moving in the opposite direction of our PD levels, is the price of Brent. Each of the spikes in the PDs we see measures a stress on oil, the financial crisis, Deepwater Horizon BP spill, the so-called Arab Spring, and most recently a couple of spikes as oil prices collapsed in December 14 and again at the end of the summer.
Three key takeaways from today's energy webinar. The first point is focused around the global M&A environment.
M&A activity within Asia Pacific, and really this is a flow through from the fact that energy demand has been shifting east. We do see that beginning to soften now, but in terms of the level of growth in M&A activity, the Asia Pacific market does represent an interesting opportunity.
Market indicators based on equity volatility are showing a weakening of credit risk across the board. But when you look at credit fundamentals, it becomes quite clear that the problem areas are those with credit scores CCC+ and below.
Fundamentals, however, start to distinguish between the different industries within the energy sector. In this chart, this is a probability default model based on business risk, country risk, as well as financial ratios of the companies within the energy sector. In here, you can see that there's much more market difference between the upstream and downstream industries within the unrated universe.
My presentation today is on the impact of low prices on Asia-Pac oil and gas companies.
We expect a gradual improvement in oil prices going forward. In 2016, the oil prices forecast is about $55. That will be improved to $65 in 2017. And in 2018 onwards, we see a further improvement to $70. I think our long-term price from 2018 onwards, that expectation is really based on the industry fundamentals.